Okay. So Frank's not here, so I'd like to call the meeting of the New York Pension Board to order. First up, I guess, I'll look at the minutes from the last meeting. Are there any comments on them?
Nope.
My name is misspelled, actually. It's Pramer, not Prae. Other than that, no comments.
Okay. Any other comments with that? Can I motion to approve them?
So moved.
Second?
Second.
All in favor? Aye.
Aye.
Motion approved. Let's run through the pension applications very quickly.
Sure. So we have 4 applications on for today. The first one is Josephine Segan, who's from the Board of Ed. She was the budget coordinator. She was with the Board of Ed for 9 years and 5 months. The commencement date would be October 16th of 2023. It's a vested pension, and she selected option 3. Ellen Grady.
So, before you go on to,
I'm sorry.
so she worked, it said last month of employment is 2008. So she worked from 99 to 08.
Yes.
So,
And then because at that point she was not of retirement age, so that's why it says vested instead of
okay,
regular.
got it. Okay, understand.
So that's the difference that
Yeah.
when she left, she was vested in her pension, but she wasn't eligible to collect it at the
Got
time.
it. Yeah, we've got a couple of those here.
Yes,
Yeah, okay,
yes.
thanks.
The next one is Ellen Grady from the Board of Education. She was a Secretary 1. She was with the Board of Ed for 18 years, 3 months. The commencement date of her pension will be November 25th of 2023. This is a regular pension. She selected option 1. James Finch, who was with Management and Budget. He was the Director of Management and Budgets. He was here with the City of Norwalk for 5 years. The commencement date would be December 19th of 2023. This is a vested pension, and he selected option 3. Sorry. And then last is Herman Naring Jr., who was with the fire department. He was a fire dispatcher. He was with the fire department as a dispatcher for 16 years and 9 months. His commencement date will be January 2nd of 2024. This is a vested pension, and he selected option 3.
Okay. Anybody have any questions or comments on the pensions?
Motion to approve.
Second? Dave, give us a second there, Dave.
I second it.
All in favor? Aye.
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 Motion's passed.
Thank you.
Okay. We jump over to the Midwest guys?
Yeah, sure. Mark, looks like you're on. Is everyone on from your side?
Hi, Britt. Hello, everyone. This is Mark Romano from TCW. I'm expecting 2 colleagues to join me. I'm not sure if they're showing up on the screen yet. I'm talking to you from a hotel in San Francisco. I'm on the road right now, but behind me on this screen is our new headquarters that we moved into on Monday of this week. And sorry for my voice. It's a little scratchy at the moment, but that is our new headquarters again as of this week. And I'm hoping that the new video room and all of the connections are good. I have today joining us momentarily Brian Whalen, who is our co-CIO at TCW, and Jerry Cudzo, who is a just recently named generalist, which is a key position in our portfolio manager team. Britt had asked that we review some of the organizational changes that we had. We had a couple of retirements that we announced and also promotions along with that. So in order to accommodate that, I invited Brian, who leads the, as I mentioned, is co-CIO, and Jerry, who did get one of the promotions as a new generalist. So let me ask you, I don't see them on screen. I just got a message that Jerry can see and hear me, but I guess we can't see them. So we're having a little technical difficulty with the new headquarters, but I know they're on.
I'm
yes.
sorry. I do see somebody in the attendee with their hands raised.
Yes. So I just allowed them to talk. I wonder if that will help.
All right,
Okay.
okay, can you hear me?
Yes.
Yes, we can.
Okay, great, let's see here, let me lower my hand. How about it, is the camera on in here or no, not yet?
No.
Okay, let me try to get the camera working now.
Okay, Jerry, while you're doing that, I'll continue on,
Great.
in order not to slow the meeting down. And by the way, you're, I guess, in Fuji, which is, I guess our conference rooms on that floor are named after different mountains. So, anyway, hopefully in the Fuji screen, you'll see Jerry and Brian pop up shortly. As part of Britt's instruction for this evening, he wanted to make sure that we, updated the board on TCW in general. I'll just spend a minute doing that, and then get into the personnel changes, and then go through performance. And one of the things that I want to make sure is we sent a last minute update on our presentation deck. Hopefully you have that. We'll be addressing that, and it's important. I'm sure, I know many on this board are involved in the markets. It's been a very interesting last 5-6 weeks, and today it was an incredible day on what's occurring in the marketplace. There's Brian. Brian, hello. You're registered as Rebecca, your assistant, but we can see you now, just to let you know.
Yeah, I apologize. One of the we could hear the whole thing. We actually heard earlier parts of your meeting. One of the great things about our new office is how it looks, and one of the bad things is how it functions. So apologize to everyone. We're going through a little bit of a scramble here.
Yeah. So let me just mention that if we want to look at the deck real quick, we can do that. And hopefully you all have the new one. I'll just point out a couple of features up front, and then we'll get going into the meat of the presentation. So page 4 lists the TCW facts. We've been in business since 1971. Originally, it was called Trust Company of the West. We offer our management through 2 mutual fund and other named vehicles, which is TCW and MetWest. We have offices throughout the U.S. and internationally, which are listed there on page 4. Our AUM, or assets under management, is shown on page 5. You can see that it's 202 billion in AUM. Of that, majority is bonds. You can see it's 183 billion in bonds. And our flagship, which you're invested in at the City of Norwalk, is in Core Plus. That's what we're most known for. The last page on the introduction really is a segue into what Britt had asked us to cover, and that is the organizational changes which we announced. Page 7 is best for that. We have now 5 generalists in the top box. 2 of them are with us tonight. That's Brian and Jerry. And this box has gone through some changes lately. We've had some retirements announced. Laird Landman is retiring just in a couple of weeks at the end of this year. Steve Kane is retiring at the end of 24. And in order to accommodate that, we named 2 new generalists. One is with you, Jerry Cudzo, and Ruben is the other person named who got promoted. So with that as an intro, maybe a few more comments, Brian or Jerry, on the personnel changes and what this means for our philosophy and process.
Yeah, just on that issue, Mark, appreciate everyone can hear me. Can you hear me okay?
Yeah.
Okay,
Yes.
great. Switch to speaker so you don't have to see me with that headset on. Yeah, look, I've been with the team for 20 years. I've had the privilege of doing that. It's a kind of a process and investment philosophy that has been around for a quarter century. So I've been around for most of that. My partners, they achieved the ripe old age of 60 something, and a few of them are already kind of looking forward to other parts of life. And so we wish them well. I think what I would say is the process, the management structure, how we think about investing in fixed income, and basically the product, Norwalk you are investing in has been institutionalized. And I'm happy to walk through some of that in terms of like the thoughts and the positioning and recent performance and going forward expectations. We'll walk through that, but we have 15 members on an investment committee, our fixed income investment committee. Two of them, one of them is retiring at the end of this year, one will be retiring at the end of next year, and one is relatively new to the firm. But the other 12 of the 15 people are people that have been here for years through cycles. They dream in the investment philosophy and the process. It's first nature to them, and so I think you should kind of expect to see. I guess the one thing I can promise as the CIO is that, you know, the way we go about thinking about the markets and constructing a fixed income portfolio will be no different than it's been, you know, for the last 25 years. And it's up to you to decide whether that's good or bad. So let me offer, you know, this is your time, and I know you've got a lot on your agenda. You could just fire questions. I could walk through a little bit briefly, just kind of thoughts to frame our outlook on the market, or we could kind of jump to a page and just talk about positioning, and I could kind of give you the most important kind of characteristics of the construction of the CIT right now, and also kind of like through that construction, you'll also get a sense of the view. But let me stop and you direct me.
Yeah, I guess I think I'd be interested in your positioning, where you see things going in 2024, you know, in light of the Fed comments today.
Yeah.
And I guess it's also, you know, we show you as your benchmark against the Bloomberg aggregate. Do you think, you know, do you think that's the right benchmark for you, and how do you think you've been doing against it?
Yeah, let me start with the last. Yeah, it's the best benchmark. I couldn't think of a better one. I would say that's, you know, we manage about 170 billion of fixed income. I'm going to guess 120 of that is benchmarked to the ag, you know, in some form or the other, whether that's a core plus. So I think we've got the right benchmarking comparison. Our performance, if I could kind of sum it up over the last 3 years, has been index-like, which isn't bad. I would say, you know, in fact, it's kind of typical for us. And what I mean typical is, you know, we have a value style. And so, you know, when we see, you know, business cycles, or if we see credit cycles aging, kind of getting long in the tooth, and we have expectations that there is going to be kind of a change in the environment, you know, and that's the economy, that's credit cycles, that's credit spreads, that's equity valuations. You know, we tend to kind of pivot and kind of generally move in a value way before the herd. And what that usually leads to, and it's the same exact thing happened in late 2019, we had kind of defensively positioned the core plus strategies. We had dialed down the risk, and we were kind of index-like on a 3-year time period, with the expectations that, you know, the markets were priced to perfection. And we rarely say we're 100% confident, but we are always 100% confident that, you know, things will never be perfect and go exactly as planned. And that is what it looked like in 19. We weren't forecasting a pandemic by any means, but obviously something came along and changed the whole landscape, and you know, we benefited from that. And this time around, basically, if I kind of sum up the house view, is we don't believe it's different this time. We don't believe in fairy tales. We believe like a 500 basis point hiking from the U.S. kind of central bank, and then, you know, all kind of global central banks with ex-Japan, that, you know, long and variable lags is, you know, it is tried and true. You can go through history and see that it's rare, if ever, you kind of avoid a sharp economic slowdown, although we are human beings. Generally speaking, we like to see things immediately. But if you want to look on page 22 of that presentation, if you have it, I'm not going to kill you with a flip on a page deck, but I think it kind of sums up the house view series. The one that says, sorry, Virginia, I hate to break it to you, kid, but monetary policy it's not a switch, it's a dimmer. And that is really the house view, meaning, like, you know, this kind of no landing, soft landing narrative. It believes in that it's different this time because, you know, we haven't seen a recession yet, and it's been, you know, almost 2 years since we started this hiking cycle. And we point out here on page 22, a lot of ways to measure long and variable. Well, you know, on the upper left, it's, you know, average historically going back to the 70s, from the time the Fed lifts off to the time the official start of recession has been 29 months. If that's accurate, we get to a recession in the middle of next year. The other one tells you about when Fed funds peak, to the point of a recession is about 7 months. And given the Fed policy, the Fed meeting today, it looks like they have peaked. The Fed is done. That's what they're telling us. That means we hit the recession in February. And if you look at just a curve inversion, 2s, 10s, the difference between 2-year yields and 10-year yields, if you look at that as your indicator, we're actually a little late. Should have started the recession middle of 2023. And that bottom right-hand graph, I think, is great. You know, it's the evolution of unemployment from the point at which the yield curve inverts. And, you know, we're in this current cycle, that red line at the bottom. If you look at all those cycles going back to the mid, you know, I guess that's the late 70s, what you'll see is, again, it's not different. It just takes time, you know, and eventually, you know, the transmission mechanism of monetary policy finally works its way through the system. People have to roll their debt, whether they're consumers or people. And then eventually recession starts slowly, unemployment picks up slowly, and then it picks up steam. And that's, you know, we're in this little Goldilocks period right now where, you know, the market seems to be, it's breathing a sigh of relief that the rate hikes are over. And so we're seeing equities rally and credit spreads do really well. But in our estimation, they fail to recognize the reason that the hikes are over. And it's not just that inflation metrics are turning and inflation seems to be melting. It's that the Fed sees what we believe we see, which is a lot of tea leaves kind of showing up on the dashboard, kind of telling us that this economy is going to slow more than the markets expect. And so we've positioned in a way, and maybe that's actually a good transition. Let me flip to the portfolio on 19. A little snapshot of the fund characteristics, and let me start, kind of walk you through it. And well, obviously yield to worst. The good news about the last 2 years of pain in fixed income is that now you can look at a core plus investment and you look at about a 5.5% yield on that. So, you know, the way I like to say it is bonds can be bonds again, finally, you know, in your portfolio. They should behave and do what you need them to do relative to your equities, your alts, or your commodities, whatever you got in there. Duration. We have one of the reasons we've been index-like, and some of our peers have outperformed the index relative to us, is that they've continued to be underweight duration, or at least flat, kind of going with the momentum, and just, you know, particularly in the fall, not knowing when this will ever end. Will rates peak out at 6 or 7 or 8? And we've kind of held to the discipline that, you know, you never know where the peak will exactly be, but it felt to us around 5% in the middle of October, as we really saw real time how those rates were impacting in real time corporates and consumers, et cetera. It felt like the system, almost like when you drive a car kind of in your maxing out, you can kind of feel that old car start to shake a bit. It felt like the system was shaking a bit, and it felt like the right opportunity to position our core plus or our CIT here to be kind of max long its duration. And so you can see effective duration of the fund. This was the end of November. We were long relative to that index almost a year, 0.9 years. And in fact, if we did this snapshot as of the middle of October, we were long about 1.1 years, which is pretty much the max risk budget. We don't usually go much more than plus minus a year. So it felt like a great value opportunity to position the fund to have as much interest rate duration as we would allow it to have relative to its benchmark. And, you know, we'll see if it's over, but so far it looked like that was the right time to spend the budget. So there's 3 big, you know, levers or kind of tools in the belt that we're using right now to drive performance. That's duration. The second element is where there has been opportunity, which is in the high quality agency mortgage-backed security space. I don't know how many of you are bond nerds, so I won't go too deep into the weeds, but I'll just tell you, you know, these are mortgage-backed securities wrapped and guaranteed effectively by the federal government, that when you have big interest rate moves like we've had the last couple of years, their duration moves against you. And basically, because homeowners decide not to prepay, and 90% of American homeowners have been locked into their homes because they don't want to move and get out of their 3.5% mortgage rate to pay a 7%. All of a sudden, the duration on those exposures goes from 3 years to 6 years overnight. Fundamental pain in that, but, you know, again, value investing, you want to go where there's the pain. And so the spreads, the yield, the extra yield you get to be in that market relative to US Treasuries is basically, or was sitting in October at the same levels where it was during the great financial crisis. And that's really the only time in history you could find that same level of yield and compensation. Again, value, and so we moved into it, and we really overweighted that sector. And, so far, so good. It's been a nice little tailwind to it. But I will tell you, just to give it kind of bookends, the spreads, the extra yield relative to treasuries back in October was about 1.9%, call it 190 basis points. Historically, that should be about 75 basis points. And even though they've done well, they're about 140 basis points still over treasuries. So that is still an area we have a lot of exposure to. And we think, like all good, high quality assets, they will mean revert over time. And so that is kind of the second value trade we have in the fund. And then finally, this is the quiver that isn't firing just yet, but we expect it will. We have used this, kind of consensus. We've used that and taken advantage of that by basically selling credit. So de-risking the fund in terms of its exposure to corporate bonds, and particularly high yield bonds. And the belief is that not only will those types of bonds underperform in a recession, they are priced right now at tighter than historical averages. And so you're getting paid less than historical average to take credit risk in the bond market, particularly corporate bond credit risk. And that is very odd if we are truly heading into an economic slowdown. And so it's almost like it's priced to perfection. And as an active manager, we kind of sit back and look at the world and we'll say, duration, we want more of that. Agency mortgages, we want more of that. Corporate bonds, we'll sell that to you. Like, we will get underweight corporate bonds relative to an index. And the trade, and so in terms of expectations, the last 6 weeks as we've had this rate rally, et cetera, we've had very strong performance, but we've just begun. Like, we'll see how it trains out. We never like to say we know exactly how it's going to play out, but, we feel good going into 24 with the duration, still a lot to go there. The agency mortgage compression, still a lot to go there. And we love the fact that relative to our competitors, we've got less corporate bond risk and even less than the index, because we think there will be much better times in 24 to buy corporate bonds. They're going to be much cheaper at some point. And so the trade within our funds and really our platform, because we're expressing the same opinion across the board, is that, when it really becomes apparent that we will not avoid a recession, and it doesn't have to be a hard one, but we will not avoid one, corporate bonds will get cheaper, duration will rally, securities guaranteed by the government, they will rally. There'll be a kind of a flight to quality. So we will use that as an opportunity to kind of take advantage of that liquidity, sell it, and then buy opportunistically more corporate bonds and maybe a little bit of high yield and stuff like that, but in a totally different environment. And that's kind of that is our mindset. That's like an active management framework. And so we feel good. We feel like we're positioned in the right way. We've had a heck of a run here in interest rates. So, it's a good chance, gives a little bit of that back, but it seems like the tide has turned. We've kind of hit that inflection point. And 24, 25, we're going to see interest rates go the other way and everything else kind of fall into place. So as usual, I know Mark knows this, my mouth can kind of just keep going and going. So let me stop. I appreciate your patience. Let me walk through that and just see if I can answer anything about the portfolio or the economy or anything.
That was helpful. Quick, how do we interpret the negative 13% in cash and equivalents? What does that mean?
At the highest level, our government, what gets wrapped up into government includes a lot of short duration cash-like instruments, as opposed to like 5, 10, 30-year treasury bonds. And so really the right thing to do when we think about like liquidity, we take a lot of those short, high quality government bonds and even kind of single A and higher corporate bonds that are maturing within 18 months. And we think of that as almost cash-like. And so, as a manager, as I think about my risk on the desk, and when I look at my dashboard and not how the general reporting gets done, I take a good, 15% of that government bucket and I move it into that cash and equivalents.
So that's to get you equivalent with the way that the aggregate's reported. Is that
Yeah,
right?
that's right. That's exactly correct. That's right.
Got it. All right, thanks. So how do you see 2024?
I think people are gonna be really sad. I hate to be the bummer. I just, I look at the S&P up, another new building thing. Hold on, let me.
You gotta move around.
Yeah, I think it's good enough. All right, it's good. You don't need to see my attempt at a beard. I think people are gonna be sad. 21% year to date on the S&P. It's just actually, the S&P up 21% is exactly the same thing as saying, IG credit spreads are at 95 basis points over treasuries. It's all about the no landing. I just don't think it'll happen. I think is the no landing possible? It's absolutely possible, but we think of our job as just kind of managing probabilities, different paths and probability weighting them and saying, okay, what are you getting paid based upon all these potential outcomes and our assessment of it? And, we put up 10% max, maybe probably more like 5% weighting on a possible no landing path. And if it's anything other than that, our positioning will pay off. So we think things will slow. We think, even though the language has changed today, I think when the reality of the economic slowdown and growth disappointing and unemployment picking up faster than people expect, I think people will run from credit. There'll be stories about downgrades and defaults, particularly in the high yield market. And hey, what a shocker. All those high yield companies that are levered, 8 times to 1 that got to borrow at 6 or 7% for, a good 5 or 6 years. Now they got to borrow at 13%. Hey, what a shocker. The math doesn't work. Now, maybe it works for a year or two while they've got some cash and maybe they don't have to roll over all their debt, but eventually those teeth sink in. In fact, let me show you. And I'm gonna go look at 25 just for 1 second. It's the one that says there's a lot of coal in that stocking. I think, unless you're in the weeds on this every day, I don't think most people knew this, but it's this is U.S. filed bankruptcies by number going back to 2010. Look how high 2023 is. Like, when I look at that, I'm like, are you kidding me? Like, credit spreads where they are, S&P up 21%. Like, we haven't seen that type of number since the pandemic of 2020, and we've exceeded 2010. And that's just getting started. So when I look at that, I'm like, you know what that is? That's a 4 or 5% Fed funds rate sinking its teeth in on what is a fairly levered, economic ecosystem. And, as we further get into 24, and some of these tailwinds from the excess savings and the pandemic and people got to pay their student loans and all, once this really starts setting the teeth in, this will only probably pick up more steam. And so, yeah, look, I think the first 3 quarters of 24 is probably going to be a sad moment for a lot of people. If you're in the bond market, it's probably going to be a good market. But probably by the end of it, we're not for the good news is, let me give you some good news. The corporate, interest coverage is good. The general corporate bond market, there's not like excessive risk taking. There's just kind of some dead wood that needs to be cleaned out. So I would say 24, the first beginning is going to be sad, but I don't think it's going to be such a bad recession that by the end of 24, people won't start to see the green shoots again.
What size firms are in these numbers? Are these small businesses?
I would say this is going to be, like 20. This is 25 million of each. My guess is, I don't have it. It's a good question. I'm going to guess of that 183. I'm going to guess 2/3 of that's like 25 to $100 million EBITDA companies. Kind of your smaller mid-sized companies.
The smaller the representation from the smaller companies only because you think about the default rate in the leverage finance markets today, and it's approaching 2% brought in the public high yield and bank loan markets, and so we're around kind of 1 3/4%, which is a low number historically. Now we've seen that increase and normalize. I think we expect it to go to kind of closer to 3.5-4% next year. But this is capturing small business as well, which I think is where part of what we're saying is this is where a lot of the job creation takes place. It's also where a lot of the pain, where you see a lot of the stresses percolate first. is in the small business part of the segment of the marketplace. I think the last thing we'd say, I like real quick, the next page on 26. The fact that the market has gotten itself comfortable too, but with the pace of slowing in inflation, and then the gradual decline in interest rates and how the market will absorb that. I think our opinion is that, and I think Brian referenced this, but I think this chart does a good job of saying what's happened historically and how has the pace of rates or the pace of decline in rates, how has that taken hold over time? And I think our opinion is that the Fed can say whatever they want. The median dot, if you think about where median dot plots were a year ago, was like 2 1/8. So the reality of the Fed saying that they are going to gradually ease rates, the Fed will do what the economy needs the Fed to do. And our opinion is that we're seeing a real slowing underneath. And when that happens, when job losses increase, I think our thought, and just informed historically, is that the Fed will begin to reduce rates and then need to reduce rates in a much faster fashion than even the market's anticipating today.
Okay. All right. Any questions? All right, appreciate it. Anything else you think we should know?
Yeah, I think that what I would say is we are definitely positioned for a slowdown. The portfolio is of higher quality. We've reduced credit, as Brian mentioned, and increased agency mortgages and our long interest rate duration. But if the recession doesn't hit or takes a little bit longer, we are carrying higher than that of the index. And with credit spreads where they are, as tight as they are relative to the risk-free rate, we don't think a significant tightening in credit spreads will be the headwind. So barring a significant kind of inflation expectation increase with a commensurate backup in rates, we think we can perform extremely well in kind of any environment, even if it takes longer. We don't think it will. I think our thought is that we're seeing things real time and kind of that got affirmed by the Fed. But even if it takes a little bit longer, I think our thought is normal market environment. We can add a lot of value through episodic volatility that tends to happen in normal environments as well.
Okay.
You have 3 scenarios and you rate the no landing is around 5%. What do you rate the other 2 at?
Yeah, I mean, let's, make the math, 5%, I'd say something like, probably put about a 65% landing on a moderate to hard landing, and then about a 30 on kind of a soft. That's kind of how we'd see it.
And when do you think that the so you're thinking somewhere in the second and third quarter of 2024 is where we will draw the conclusion this is a little harder than we had hoped.
Yeah, I think at this point, I mean, who knows? Like, almost where when we look back in time and you get the official month that the recession began. That doesn't matter. I mean, it's all about when does the market start to read it. And I think that's going to be a first quarter event. I think we're just seeing things. First it was just anecdotal. Back in the summer and late spring, where it was just kind of reading the tea leaves and looking at. We were hearing from management companies. They were talking about soft landing a lot. But when you really dug into it, like, they were scared. You see their confidence numbers are way down. Their capital spending plans were changing. We saw like delinquencies hopping up in credit cards and autos and even mortgages. And it was like, wait, something's going on here. So, we kind of, and, the Friday's employment report, was better than expected, but that report's all over the map. There's a ton of, you can birth death model, response rates, like there's holes in that model left and right. The general trend in employment just even in the employment, the household survey, and just looking at like quits rates and continuing claims, like it is definitely weakening real time. So, I think January, February, you're going to see that accelerate. And I think it's going to be in that first quarter where the market will start to embrace the fact that, this isn't going to be no, it ain't going to be soft either. And that's when you see the pricing start to adjust.
How much do you think, though, all the fiscal stimulus we have is going to, is going to moderate that?
I think actually, look, like, I think that's pretty much gone. I will tell you, it's impossible to measure exactly how much of that excess savings is still in it. I'd say consensus is that it's been worked through. And you particularly, you can kind of see that in the saving rates have gone down.
I would agree with you there. I was thinking more the infrastructure spending, or is that not big enough to make a difference?
I don't think that's going to move the needle. I think that's going to move. I think what's maybe made this this period of time, or the economy, let's say, a little more resilient. Because look, like, this isn't just some ordinary hiking cycle. We spent a decade kind of around 0%. I mean, that was the world we were in. The delta, not just a 5% increase, but the delta going from 0 to 5, that's dramatic. And it's been shocking that we haven't seen the teeth of the recession yet. And I think one of those reasons is, it was the fiscal stimulus and all that excess liquidity still sitting in the system. But again, that seems to have been worked through, and it's been gone probably since the, early fall of this year. And so hence the reason, it doesn't feel like there's any real lifelines left for the economy.
Yeah, I think the last thing I'd say to Brian's point is the fiscal stimulus, which is done, is really what it feels like drove the inflation, because you think about what happened post global financial crisis between 2008, 2009, and 2019-20. The Fed struggled to generate any inflation with all of the monetary stimulus. And you think about expansion of the balance sheet and programs and keeping interest rates at 0 for a decade, and that we inflated asset prices at different periods during that time, but we couldn't create inflation. And I think it feels like what did that this time, and what's rolled over and proven to be transitory, is the fact that you dumped a bunch of fiscal stimulus into people's checking accounts. The propensity to spend was very high. That got worked through, and it feels like at this point now we're back to kind of monetary policy working its way through the system, which proved to be largely ineffective. We'll see if they can, but proved to be largely ineffective in stimulating inflation for a decade.
The only balance, I'll make a balancing statement here just to think about, because you mentioned calendar year 2024, and the story is going to be like, the most probable way to get to the no landing is one where, for whatever reason, this economy is able to hold on, as we get into the middle of next year, and it hasn't cracked yet, and there's something that's able to kind of get put through the system on a fiscal side. I don't think you'll get it on the monetary side. I think Powell's as independent as they get. He's going to get his job done no matter what. I don't think he cares who's in office, to be quite honest with you. He's got enough money where it doesn't matter. He can have that opinion and conduct himself that way. But I think if there's something done, on the policy side, and there's some sort of additional, whether it's a tax cut or more likely some sort of additional fiscal stimulus and spending, that may be able to bridge 24. Now, again, that's not exactly what we're positioned for, but again, we find it, let me say it this way. We're positioned for vol. That's the best way to say it. And we'll perform to varying degrees of good based upon the type of vol it is. And we'll just have to manage the journey as we go around. What we're not expecting for, and what we're not positioned for, is this kind of like Goldilocks low vol, for calendar year 2024. We think that's highly unlikely.
In terms of the mortgage-backed security strategy, is there any risk associated with a drastic slowdown and increased bankruptcies, increased unemployment, and then just basically people failing to be able to pay their mortgages? Is that risk there, and how big is that risk?
That minimal. I would say if I looked at 19, if you don't have to turn to, I'll kind of give you the answer.
Yeah.
We have, if you look there, 36.5% of the port, a little over a third of the fund is in agency mortgage-backed securities. So that's guaranteed by Uncle Sam, effectively. That's Fannie Mae, Freddie Mac, Ginnie Mae.
Yeah.
To your scenario, what I would say is, in an odd way, I don't say it's counterintuitive, but if things slow down enough and unemployment goes from 4 to 7 or something like that, and people can't pay their rates, et cetera, in an odd way that actually works for you, because these are bonds that are held at a pretty good discount to par. Think of like the average price is about 90 cents on the dollar.
Yeah.
And if people aren't able to prepay, they default. And when you're guaranteed by the government, a default at the borrower level means you get paid back at par. They effectively pay you back. So you hold it at 90 cents on the dollar, you're like, oh, hey, good news. I got 100 cents back today. That increases your return. The only potential negative would be if it was such a drastic turn down. We have about 9% in non-agency mortgages. What I would say is, consistent with our view of what we think about corporate bonds, et cetera, where we are positioned in non-agencies is all kind of top of the capital structure. Remember, this CIT, it's ERISA. So the only kind of securities we even can buy in non-agency mortgages is investment grade. So they are high up in the capital structure, and they are well insulated from defaults. And as pessimistic as we are in the economy, I will tell you, and even with mortgage rates being really high, there is one saving grace for the mortgage market right now, even in a recession. It's the fact that, unlike a lot of things, the mortgage market did learn and never forgot the lessons from the great financial crisis, meaning like the underwriting quality in the mortgage market, it is extremely high. It hasn't dissipated the quality wise from the GFC. So even in an economic slowdown, by and large, the U.S. mortgage market, you're looking at borrowers who still should be able to pay their mortgage, with the exception of life events like job loss. But again, that will be just a fraction of what we saw in the GFC, and where we are positioned is well insulated from that.
Okay, thank you.
Okay. Anybody else have any questions? Rich, good.
As we wrap up, I have one last thing to add. Right now, you're in the CIT, as Brian mentioned. You're in Class D, which is 35 basis point fee per year. Right now, we've been working on a special share class of the CIT that will be available to consultants like Cowen that have a certain amount with us. And so in late January, with Cowen's help and re-registering your shares, there will be a share class that you're entitled to that will be at 22 basis points from the current 35.
Yeah, you like that?
Up by a third.
We'll take it. All right. All right.
Thank
guys.
you, everybody.
Well,
Thank you.
thank
all.
you for inviting us, and we're always available. Just let us know if there's anything we missed today, and we'll follow up with Britt on it.
Yeah, thanks. Good presentation. Thank you.
Thank you.
Thank you.
Bye.
Thank you.
Dump the equity portfolio.
Where's Frank when we need him?
Okay. That was interesting.
Not a rosy picture being painted.
Yeah. And you guys think he's right?
You know.
If we are not in the business of making market calls. I think that is why you have a diversified portfolio.
Yeah,
So
yeah.
when things
Good
happen.
answer.
other
Smart
things
answer.
can perform.
I mean, it's, in some ways, the strategy of extending the duration a year from six to 7 years, and then it's almost like different than we were thinking before. Obviously, this is one small part of our portfolio, but my sense is that I guess he's playing the timing thing, and that 5.4% yield was the right time to lock in. Am I reading that correctly? Is that what he's thinking there? And as he does that, and what's your take on that?
I mean, they've had longer duration on the books for a while now. So, I I don't know if it's that they just extended it recently, looking to lock in anything. I think that this whole scenario that we're currently in played out longer than they actually expected.
Yeah.
And it's just that we're like now at that potential inflection point.
Finally,
like
they're
you
gonna
talked
get
about,
paid.
all the tea
Exactly.
leaves are
Yeah.
there, right? So you can kind of hear the excitement in their voice to a certain extent that like it's finally coming to fruition.
Right.
So yeah.
Yeah, I mean, if the Fed released their notes today and, you know, calling consensus was about three rate, three times, you know, lower the rates. If that's the case, being overweight duration versus the benchmark will
It's
help.
good. It'll help, right?
So I think from their standpoint, you know, before today's minutes were released, there was really no consensus on whether rates were going to stay the same in 24, if there were going to be any declines in the rates. And I think, you know, given that pessimism from the Fed is encouraging for the way they're positioned.
But that, you know, you stop and think about that, though, the market's reaction was kind of strange, because the Fed's basically saying, there's some bad looking weather up ahead. And buy more, you know?
Yeah, especially with growth, I mean, growth stocks, you know, it's.
You're right, but all they heard was that they're not gonna
Yeah.
raise rates, right? So they kind of look at that as like
Yeah.
okay, risk on.
Yeah.
Although they're to your point, they're kind of leaning into the trouble potentially.
Yeah, right.
Well, they were discounting a lot of trouble earlier in the year.
Yeah, and even as early or most recently as October, right?
Yeah.
So, yeah.
You know, a lot of the commentary after the Fed meeting today, what I heard was, you know, that this is kind of typical Fed. You put the brakes on too long, and then and then disaster, you get into an auto crash, and then, you know, then you try and hit the brakes too late, you know.
Which really ties in.
Raise the rates too high, and then you leave them too high too long, and.
Yeah, I think the self landing is something that, you know, is talked about at length, and I think fundamentally it is really hard to actually do.
Right.
And I think that's TCW's view. Are you really gonna be able to slowly take down rates? I don't know.
It's a tough job.
All right. You move on to performance review?
Sure. I was gonna focus on the October flash report. I know we were chatting about it a little bit before the meeting started, but even now, the October performance is quite out of date with everything that's happened in the last 6 weeks.
Yeah.
But just to review October quickly, stocks and bonds were down. We saw US equities slightly outperform non-US, though both were negative on an absolute basis. Growth and value within the US were mixed across the cap spectrum. And then within fixed income, the tone at that point was that rates were going to stay higher for longer, which caused more of a risk-off environment. Since October, we saw the US equity markets up over 9% in November. I think they were up again in December. So in December, the S&P 500 is up 1.7% through yesterday. And again, once the Fed's comments were released today, up even higher. Fixed income also up pretty significantly in November, ag up 4.5%. And it's up about 1.2% in December. So from a really bleak start to the year within fixed income markets that was broadly negative through most of the year, it's now trending up to more than a 3% year-to-date return. And internationally, the ACWI US up 9% in November, up slightly in December through yesterday, and emerging markets up 8% in November, slightly down given some of the uncertainty in the Middle East. And energy markets obviously tend to be more dominant in emerging markets. And I think some of the potential production issues in the Middle East are causing some worries there. But given all of that, I'll turn to page 3 of the flash report, just showing the market values. Assets were about 456.4 million, slightly overweight to US equity and private equity, slightly underweight to global equity long short, given that Blackstone was terminated. In talking to Kevin after last month's meeting, one thing we want to bring back to the board in at some point in the first half of 2024 is to revisit the asset allocation, to bring down that global equity long short target, given Blackstone's termination, as well as look at the fixed income structure, and really take a deep dive into your two managers, how they're working together, if there are any potential tweaks, whether that's adding a short duration piece, or enhancing that structure, trying to combine those two into one analysis. Okay. In terms of performance on page 4, you can see fiscal year to date. So that's really a quarter and a month. So 4 months total. I think the most glaring thing in US equity certainly is the underperformance in smaller caps versus larger caps. You can see the Russell 2500 growth down over 13% fiscal year to date, whereas large caps down about 5.5%. LSV has done well. Their value in small cap was certainly in favor versus growth over the past 3 or 4 quarters. That since then, we've seen growth come back into favor, but LSV and their deeper value style has done a very nice job over the last year, 3 years, and now outperforming over longer periods. Principal dynamic growth, slightly trailing the benchmark. We've had a tough time over the last 12 months. Most of the underperformance over the last year was in the third quarter. They really try to invest in secular growth companies and have a pretty significant overweight to tech, which has underperformed year to date. In international markets, you can see Silchester did a nice job versus the broad EFA index, slightly underperformed the value index, but continued to do a nice job on the value side. And then Walter Scott, you can see down over 12%, slightly underperforming the growth index. They have a real quality tilt to their process, and it is a low turnover, sustained growth strategy, which really has not been in favor of fiscal year to date. And then BlackRock Emerging Markets has done well. Again, this quantitative strategy is really not going to take any huge bets versus the index, but over the last year, they've done a nice job in outperforming. ABS has also done a nice job. You can see over the last year, about 4.5% return. Really sticking to their knitting in terms of how they're performing, in a pretty broad down market period for US and international equities. While they were still negative due to being net long, it was certainly within expectations. Then finally on page 5, we heard from TCW. Again, most of their underperformance over the last year to 18 months has been due to that duration positioning. Prudential Core Bond Fund has done a nice job. It's a very conservative fund, and you can see over the last year some nice outperformance. UBS has been a great diversifier. You can see over 2.15% fiscal year to date in an environment where both stocks and bonds have been negative. And then finally, PIMCO All Asset, down for the fiscal year to date, but longer term continues to be a good diversifier for the portfolio. And just so you remember, this PIMCO fund has a lot of different assets under the hood, including public equity and public fixed income. I think about 30% of the portfolio with PIMCOs in equities, whether it's emerging, non-US. So it's really being driven by that. Any questions on performance?
Is that it, except for the rebalancing discussion for the regular board meeting?
I think so.
Yeah, let's go into that.
It's still on, it just.
Okay.
What's interesting is, I guess one thing is, if you take his scenario that he described to us, being so negative from this point on, how do we see the almost like the fund ending up at the end of the year? If it really was down as much as he's describing it, recession and really impacting, the portfolio, and do we feel good about that?
I would say that the objective isn't to necessarily set up the portfolio for any 12-month period.
Yeah.
Right, it's for a much longer time period, and when we go through the asset allocation studies and the asset liability studies, it's always with a much longer time frame in mind, and the assumptions are built on a 10 to 15 year time horizon. So it's always interesting to talk with portfolio managers about their shorter term views and how they're setting up their portfolios, but I think it's important to step back and take a longer term view and kind of see the forest from the trees at times.
Okay, all right, it's good.
Yeah, and one thing, I don't think anyone this year was predicting the S&P 500 being up 23%. Year to date, the NASDAQ 100 up over 50%. It's a very narrow market, but for instance, we'll talk about in the rebalancing analysis, we made an attempt to try and update market values based on beta returns in November, and your Russell 1000 index fund estimated to increase 11.5 million in 1 month, which if we're raising 10 million, all of a sudden,
Do it.
but it's just, coming off of October, I don't think anyone saw markets ripping like that. So to Kevin's point, positioning it for the long term and having diversification so that if equities are down, there are other parts of the portfolio that can zig when they zag. And that's, I think, ultimately the hope of the fixed income portfolio.
Market timing is hard to get right.
Yeah,
Sure is. Otherwise, they wouldn't be doing it.
Sure is. So if we pivot to the rebalancing, if you open up the Excel file that I sent around, the first tab titled Pension 1031 shows the preliminary market values from the October flash report. You can see we're recommending taking the funds from the BlackRock Russell 1000 index, which if you use those market values and market values had stayed the same through today, it would bring you slightly underweight to US equity and largely keep everything similar. And if we take a look at the second tab, Pension November. So here for the US equity composite, the international equity composite, and the domestic fixed income composite, we took the benchmarks return for each of those three and applied them to the market values from October. And you can see pretty significant increases, US equity going from about 165.5 million to 181 million. International equity going from 103.5 to 113, and fixed income going from about 80 million to about 83.5 million. So we're hoping to get a little better of a more clear picture in terms of where we are today in terms of market values. And if you take the 10 million from BlackRock, US equity will be right in line with its target and most likely slightly above it.
So again, you took the 1031 and applied the market growth,
Yes.
index growth. Okay.
Yep. So The Russell 1000 index in November was up 9.3%. The ACWI ex-US index was up 9%, and the aggregate fixed income index was up 4.5% in November.
Is there any view on, the US is where we're over, but what was the growth in November for the international indexes
9%,
versus what for the US?
9.3.
Fixed income was what?
4.5.
So you need a motion to raise $10 million cash by selling 10 million of the BlackRock Russell 1000 index.
You so moving?
I am moving.
David, you want to second that?
I'll second that.
All in favor?
Aye.
Aye. Done.
And that 10 million will last for how long?
Should be until March.
March.
Yeah, we're doing these quarterly.
I think it's about 3 million a month.
Okay.
Yes, we still average about 3 million a month for our payments to our retirees.
Okay.
Okay. Anything else on the regular pension meeting? If not, for the motion to adjourn that meeting?
I move to adjourn the regular pension board meeting.
I second it.
All in favor, aye.
Aye.
Motion accepted. Moving on to OPEB.
Okay,
Performance review.
Do you have to approve minutes from?
Do we have minutes for that? I don't have minutes. If there were minutes, let me see if there are minutes in the other. Mention backup, I don't think so. No, we don't have any minutes here.
I don't see any,
I didn't see any.
No.
just for the last, yeah, the pension.
Oh, wait, hold on. Yeah.
The last meeting was in August, I
Yeah.
believe. Or September, excuse me.
Yeah.
Yeah, no, nothing here. Yep. Okay. We'll move on to the OPEB performance.
Yeah, if folks want to pull up the third quarter OPEB performance report. Again, to Britt's comment earlier, this probably feels a little bit like ancient history at this point.
Yeah.
So I won't belabor going through necessarily what occurred during the quarter, other than to just remind folks it was pretty tough across the board, across all asset classes. This was kind of, to TCW's comments, this was sort of like the first quarter that we started to see cracks and people were really, fears of recession were starting to show through across asset classes. So US equities were down almost I think only 2 of the 11 sectors in the S&P were positive. International fared even worse, and in some respect because of headwinds with the US dollar. Fixed income was down for all the reasons we've gone through. But I'm gonna start maybe just touch base on, it's page 20. If you're looking at the page number in the bottom right, it's 21. Just quickly, it's a snapshot of the asset allocation versus the target asset allocation.
Okay.
All asset classes are very close to one another at this point in time. As of the end of the third quarter, there was a little bit excess cash sitting there.
19 in the deck.
Is that what it is?
Yeah.
Okay. little bit more cash sitting, but
This is
otherwise,
the.
executive summary.
yeah, sorry, I'm on the standalone 3Q
Oh,
23.
okay.
Okay.
Page 21.
Yeah.
Okay, yeah, sorry.
So really no concerns in terms of where the asset allocation stands, currently. If we,
Chitsame, one question. I know we raised cash for OPEB benefits. Do you know when those will start to go out the door?
It's now you there?
Sorry about that. Yes, we did started drawing down the cash from Northern Trust, our custodian for OPEB, and currently in December, we have about 1.8 million of available cash.
Got it. Thank you.
okay, all right, so we brought that down quite a bit since the end of September. Great, so I actually now flipped ahead to page 20, the bottom right-hand corner is 24. If you're looking, at the top left of the PDF, it's 23. Just taking a look at performance. Again, domestic equity, because we've got the Vanguard total stock market, is pretty much on, right on top of the benchmark, down about, 330 basis points. On the international equity side, the Vanguard total international stock was slightly underperforming the benchmark there, down 4% overall. But really nothing of concern. We typically would expect that to be pretty close to the benchmark as well. Fixed income side, this should be nothing new to everybody in terms of the Prudential core bond and obviously the Met West bond that we just went through.
These are the same product.
Yes.
These are the same product. And then again, same product here is the PIMCO All Asset. Maybe I'll just expand a little bit on this one. This is the same product that Britt kind of just alluded to, but they call it like their 3-pillar approach, right? So it's the mainstream equities. I actually just looked at it. So as of now, they've got 12.5% there. And then the core bonds, which is the second pillar, that's 30%. And then the bulk of the portfolio is what they call their diversifiers, and that's at 57.5%. What is included in that diversifiers bucket? So it's TIPS, credit strategies, liquid alts, EM bonds, commodities, REITs, MLPs, and emerging market equities. They think that in their current posturing, the expectation is that the diversifiers are priced to what they believe are going to be really attractive, sort of uncorrelated returns going forward, and hence why they have the bulk of the assets there. They're much less favorable on equities going forward, probably for a lot of the same reasons we just heard from the folks on the call this evening. The fund was down 2%. TIPS, EM equity, and EM bonds were really the largest detractors during the third quarter. But they're not pulling away from that. If anything, they're sort of leaning into that third pillar, that diversifiers pillar. So again, just a little reminder to folks, because even myself, I kind of wanted to understand where they were at currently with things. So overall, no concerns on the OPEB, any of the managers, the allocation. We think everything's in a decent spot, but happy to answer any questions.
That's good.
That's it.
I think so. Yeah. Good. Any other business to discuss? All good? You want to make a motion to,
I think that we adjourn.
Second it?
all right, all in favor? Aye.
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 All right, thank you guys.
Thanks, everybody.
Thanks,
Have a
guys.
good holiday, everybody.
See you,
Yeah.
Dave. Chitsame, happy holidays.
Great holiday, everyone. Absolutely.
New Year.
Yep.
Hard to believe it's already here.
Yeah. It's not even winter yet, next week.
Winter starts.
I'm not,
Monday, Tuesday or something like that.
Sounds like an argument I'm gonna get into with my wife. Winter started a month ago.
Yeah.
I agree.
It's cold.